So this is part number 26 of this multi-part video series. Fantastic series this is going on. Students are loving this series. Here is an example of a breakout that did not work. It is very important to understand the strength and the weakness of any strategy. We will look at this breakout which did not work out. It hit the stop loss. We'll also look at how we could have avoided or reduced or eliminated risk. You can't avoid or eliminate risk completely, but you could control or reduce risk, right? So this is a very good example of that. So this is Syrma SGS technology company. This is an old chart. This is December 2023. So as per the SEBI regulations, we have to look at old charts. So this chart does not violate any regulations as such in India. So that is why I have taken this chart for discussion. So let us just assume that this is a stock that you have filtered, shortlisted, and selected using the 5 kinds of analysis, which is liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. This is a stock that you have selected. Okay. Most people only do fundamental and technical analysis. They fail to do liquidity analysis. They don't look at comparative analysis. They don't realize that it's not a leading stock. And most importantly, they don't pay attention to the market conditions, because in a weak market, 3 out of 4 stocks will help you lose money, not make money. Okay. So let's assume that this is a stock that you have filtered, shortlisted, and selected based on the 5 kinds of analysis. So let us draw the base. This is a cup without a handle. Okay. This is a consolidation, a base. See the first base, the stock IPO'd in August 2022. The first base was this. So when the high of this was taken out by this candle, that's base number 1. After this candle, after this bar, there is not a single bar after which you had 3 weeks of consolidation. Okay, so if you look at this bar, see after that you had 1 week of consolidation. So 1 bar below the high of this bar, this entire bar is below the high of this bar. So 1 week of consolidation, then again that high was taken out. Again this bar, 1 week of consolidation, again that high was taken out. Again this bar, 2 weeks of consolidation, again the high of that bar was taken out. Again this bar, 2 weeks of consolidation, again the high of the bar is taken out. This bar, again 2 weeks of consolidation, again the high of the bar is taken out. So this is the only bar, which is 16th October 2023, after which you have 3 consecutive bars, which are the entire bar is below the high of this candle. Sorry, the high of this bar. Okay. So that's where you start counting the second base. Okay. So you need to know this. There is a base counting video on my YouTube channel where I have explained this in detail. After a particular bar on the weekly chart, you need 3 consecutive bars which are below the high of that bar. So if you look at the high of this bar, what is that? 664.80. For 3 weeks, the price never even touched 664.80. The high of this bar is 661.85. Okay. So 3 weeks, the price remained below that 664.80 consecutively for 3 weeks. That's officially what you call a base formation. Okay. So this is a base. You call it a flat base, or you call it a cup base without handle, or whatever. That's a base. And the high of the base becomes the pivot point. So 664.80. Okay. So I will write here. We'll make the blue zone. So this is 664.80. Right? Yes. This would be 5% above that. So 664.80 multiplied by 1.05. I have a calculator here. So 698.04. 698.04. See, that's the buying range. Okay, after the base. Then we'll draw the selling range. So this would be 20% above the pivot point. So 664.80 multiplied by 1.2. That's 797.76. 797.76. This would be 25%. So 664.80 multiplied by 1.25. 831. So 831. And the color would be green. That's the selling range. So buying range, target, and now we'll draw the stop loss. So red color coordinates. This would be 5% below the pivot point. So 664.80 multiplied by 0.95. That's 631.56. 631.56. And this would be 664.80 multiplied by 0.92. That's 8% below. So 611.61. That's it. So we have the buying range, stop loss range, and the selling range. It's very, very simple. Nothing complicated about this. Okay. Now we get into trade execution. So this is base number 2. That was base number 1. So this is an investable base, assuming you have selected the stock. Have a look at this base. If you notice two red bars, okay, out of which one of them is a very massive 15% crash on twice the average weekly volume. Okay, on that in that week, the volume was almost twice the average weekly volume. So that's a big uh, selling week. Institutionals probably sold the stock. People who bought here probably exited the stock in these 2 days. So probably there is retail participation, not institutional participation. And even when the stock is going up in these 5 weeks, it is going up on low volume. So high volume crash, low volume rise. What does that mean? That is not a good sign. We need low volume crash and high volume rise. Okay. So this is, if you look at price and volume action, this is a risky base. Even though it is base number 2, it is a risky base. And in a very short period of time, let's say from May till December, so roughly 7 months, the stock has shot up from 343 to about 661. So roughly in 7 months, the stock has doubled. Okay, so very aggressive price action has already taken place. So some amount of profit taking or institutional selling is expected from the stock. So that's a risky base that we are talking about here. Okay. So price and volume action tells us that this is probably a risky base. The cup also tells us that this is probably a risky base because there is no handle inside the base. A cup with handle is a more stable base than a normal cup because there is no proper consolidation on the right side. Correct? Plus, rise on low volume, fall on high volume, not a good sign. Okay. So we already know that we are getting into a risky situation. Now, what are the ways to control risk? Well, there are 3 ways to control risk. When you enter with a small position size. When you enter, rather than keeping stop loss at 8%, why not keep it at 5%? Okay. So going in with a small position size, going in with a tighter stop loss, not the normal 8% stop loss, or doing both. Okay. So in this case, it would be advisable to do both. If your plan is to buy 100 shares, rather than buying 100, why not buy 50 shares only, not buy the remaining 50? If your plan is to keep the stop loss at 8%, why not keep it at 5%? So reduced position size with reduced stop loss, tight stop loss, significantly brings down the risk and still gets you into the trade. Correct? So let's see what happens next. That's Monday, Tuesday, Wednesday, Thursday. So on Thursday, you see how much is the volume? 3.53 million. and the average is 4.76 million. What does that mean? That means Monday is gone, Tuesday is gone, Wednesday is gone, Thursday is gone. Still, the price hasn't broken out of that blue line. For a normal breakout in Monday itself, the stock either touches the blue line or it covers up nearly half of the average weekly volume, more than half of average weekly volume for a normal high volume breakout. Here, the first 4 days of the week are gone and the volume has not even touched the blue line, which means what? Which means this is not going to be a high volume breakout week. And we already know the stock is risky, which means what? You now have two glaring risk factors in front of you. The price and volume action is weak, the breakout action is weak, the fall is very aggressive, the rise is not very aggressive. So considering all of this, you would go with a further reduction in position size. So rather than buying 50, why not buy 25? So original plan was to buy 100, but since there was weakness, we chose to buy 50. Since there is further weakness, I mean not a high volume breakout, we chose to buy 25. So ultimately from 100, we come to buying quarter of our planned position size. So further reduction of risk as the market or the price action develops. So I would end up buying 25 shares of the stock here. So you see, this is all risk management. All trading is risk management. The system remains the same. The pivot point, the buying range, the selling range, the stop loss range remains the same. The weekly chart layout remains the same. The criteria of shortlisting, filtering, selection remains the same. Everything is same. What is changing is the tactic or the position size. That's the only thing that we have in our control. The stop loss, the position size, and our judgment of whether it's this risky base or not. Okay, if this was a cup with handle, I would buy 50 shares. I would not buy 25 shares. Okay, because there is proper consolidation on the right side. So let's say I buy 20 shares. Look what happens. 25 shares with a 5% stop loss. It fails. The stock eventually fails. See, by this time, the stock has already broken. Here, in this week, the stock fails to break the 10-week simple moving average. Any stock that closes below the blue line on high volume should never be held. Okay. And by the way, by the time this week came, our stop loss is already hit. So this is a stock that failed. See, in this week, it finally broke the blue line, which is the 10-week simple moving average, but on low volume, still not a glaring signal to sell. But you continue going forward. See, high volume closing below, that's a clear sell sign. So if you are someone who does not operate with a stop loss, which I never recommend, by the way. So if you don't operate with a stop loss, at least you should be selling the stock here. Otherwise, you should be you should expect more pain going forward. Okay, so that would be an example of a stock breakout that did not work out, and how we could have either avoided the stock entirely. See, sometimes you could just choose to avoid the stock, because if there are other opportunities in the market, why not go with those opportunities and stay away from this kind of a situation? Okay. Moreover, if I remove all this, I take you back to the, yeah, I take you back to this. Moreover, if I draw the base, which I draw on the daily time frame chart, okay. So if I draw the base is in here, yeah, look, how much price action do you see in the green zone? Hardly any price action. The stock doesn't spend much time in the green zone. What does that mean? The same concept is applicable on the daily time frame chart. This is point 1, that's point 2, this point 3. The stock doesn't spend much time in the green zone, which means there is overhead supply here. Okay, that overhead supply will weigh on the stock. If you convert this to a daily time frame chart, this green zone, it will remain the same, correct? So please understand that if the stock is experiencing overhead supply, there are a lot of people who are sitting here who are stuck inside the stock. The moment the stock enters that price range here, a lot of these people who lost money here They would want to sell their stock and get out of it, right? In the fear that it would fall more. So that's called overhead supply. So if you don't see much price action in the green zone, that's a risky base. Okay, please understand that. So what I'm trying to tell you here is that the chart speaks to you, the base speaks to you. You should listen, you should observe. Don't try to automate things. Okay, you could automate things like filtering, shortlisting, stock selection, and all of those things. But position sizing cannot be automated. Stop loss placement cannot be automated. A visual interpretation of the base cannot be automated, and things like that. So human judgment, human experience is very important for you to understand. Just by looking at the base, you should know with experience that there is risk here. That should immediately trigger a course of action in your mind which says low position size, tight stop loss, and micromanagement of the trade. Okay. So this is an example which I wanted to show you. Not every base that you buy is going to work out. And the most successful traders in the world have a 40% success ratio. So 6 out of every 10 trades they take go against them. Let me repeat that. 6 out of every 10 trades they take go against them. But what makes them champions is the control over the stop loss, control over risk. Okay, when they lose less, but when they make more. That's the reward to risk dynamic there for you. Okay, so that's part number 25 or 26. I don't remember, but we will continue looking at more charts in the future parts. Thank you so much.